You ever notice how in economics, some of the most important ideas are actually invisible? That's exactly what's going on with R-star, this so-called neutral rate of interest. It's like the gravitational center for central banks, but you can't just open a spreadsheet and find it.
It's wild, isn't it? R-star isn't just some technical detail every big policy move, whether it's the Fed, the ECB, or the Bank of Japan, sort of orbits around what they think this invisible rate is. But we're talking about something that's never directly observed, only estimated and fiercely debated.
Exactly. And now, in early 2026, the stakes have shot through the roof. After over a decade where everyone assumed R-star was stuck near zero, there's suddenly real evidence it might be rising. If that's true, the era of ultra-cheap borrowing could be ending. That's a huge deal for governments, investors, and honestly, all of us.
And the uncertainty makes it all the more nerve-wracking for policymakers. They're basically steering the economic ship by starlight, except the star keeps moving, and they're not even sure where to look. That leads right into how we even got here.
Let's back up a bit. After the 2008 crisis, central banks slashed rates and kept them super low for years. Remember all the talk about secular stagnation? People genuinely believed that the natural rate was barely above zero, so keeping rates low was just the way things were going to be.
Yeah, and that period saw this cocktail of aging populations, lots of global savings, and not much appetite for risky investment. The Laubach-Williams model tracked those forces and basically told policymakers, don't expect R-star to budge anytime soon.
Then, COVID hit. At first, it reinforced the low-rate story, huge fiscal transfers, supply chain chaos. But rates stayed rock bottom. The twist came with the inflation shock. Suddenly, growth refused to buckle even as central banks hiked rates aggressively. That resilience flipped the script.
That's what really jolted the consensus. Instead of the economy sputtering above what was assumed to be the neutral rate, it just kept chugging along. That suggested the real equilibrium rate was higher than anyone thought, a huge narrative shift. And now, with AI spending, energy transitions, and persistent deficits, we're in a new chapter entirely.
You know, it's not just technocrats arguing over decimal points. There's real intellectual drama here. Wixell, Keynes, Friedman, their theories all color how we think about R-star.
Totally. Wixell started it all, picturing a natural rate that keeps prices stable. If market rates dip below that, inflation pops up. Push them too high, and you get deflation. It's basically the backbone of how central banks think about targeting inflation today.
But then Keynes came along and said, hey, psychology matters, expectations, confidence, all that fuzzy stuff. If animal spirits are low, even zero rates can't get businesses to invest. That's what the post-2008 era felt like. Plenty of cheap money, but not enough optimism.
And we can't skip Friedman, who doubled down on structure, demographics, productivity, long-term trends. The inflation spike of 2021-23? That was a real-world test case for the natural rate theory. Set rates too low, and inflation roars back. It's fascinating how these old debates shape today's policy arguments.
Funny enough, economists sometimes compare R-star to a character in a Pirandello play, real, but searching for an author. It's essential for making sense of policy, yet always a bit out of reach.
It's almost poetic. Without R-star, central bankers have no anchor. But try to measure it, and you get a whole constellation of answers. One Fed model says 0.8%, another says over 2%. Market estimates go a different direction. It's a moving target, shaped by the model you use.
But we can't just throw up our hands and walk away from it. Without any neutral anchor, policy becomes pure guesswork, no framework for deciding if rates are too tight or too loose. The trick is learning to manage that uncertainty instead of pretending it doesn't exist.
That's where Bayesian thinking comes in. Rather than pretending there's one true R-star, you build a probability map updating your best guess as new data comes in. It's a humbler, but also more honest, way of running policy in an uncertain world.
So, how do central banks actually use all this uncertainty? Bayesian analysis is becoming their secret weapon. Instead of fixating on a single number, they track a whole distribution of possibilities and adjust as the signals change.
Exactly. Picture four main scenarios. The old secular stagnation world, a moderate shift upward, a true new era with high neutral rates, and the nightmare scenario fiscal dominance, where politics tramples independence. Policymakers assign probabilities, then nudge their policy as evidence flows in.
And that evidence is everywhere. AI investment numbers, the size of fiscal deficits, immigration shocks, market signals, even political drama like the Fed independence fight. Each bit of data shifts the balance, raising the odds on some scenarios, lowering others.
Right now, the best guess weighted by those probabilities puts R* for the U.S. in the 1.4 to 1.65% range. But that could swing quickly if AI productivity surprises on the upside, or if fiscal policy suddenly tightens. The main message? Policy has to be gradual, responsive, and open to updating as the world changes.
All this talk about models and probabilities is fascinating, but it's not just academic. If R* is truly higher now, the consequences ripple everywhere. Public investment gets pricier, zombie companies are forced to adapt, and asset valuations get recalibrated.
It really does hit home. Think about mortgages. A generation of homeowners who locked in at 3% rates are suddenly facing refinancing at much higher costs. Equity markets too, if rates are structurally higher, you can't justify sky-high stock prices unless earnings growth takes off, maybe thanks to AI.
Governments feel the squeeze too. Projects that made sense when money was almost free now have to clear a much tougher hurdle. There's also growing premium on real productivity. If AI can actually deliver, it justifies both higher rates and higher growth. If not, we're in for a reckoning.
And let's not forget, central bank credibility is on the line here. If policymakers misjudge R* or let politics take over, we risk repeating the kind of volatility we saw in the 1970s. The outcome shapes not just the cost of borrowing, but the entire architecture of trust in our institutions.
Wrapping up, it's clear that the neutral rate hasn't disappeared, it's just moved. The challenge is less about finding a magic number and more about updating our estimates honestly and defending them against political interference.
What stands out to me is how much depends on getting this right. If central banks keep their eyes on the shifting stars and adapt as new data comes in, they can guide us through this new era. But if they lose sight or bend to pressure, the risks to the economy and to their own legitimacy are enormous.
The big takeaway? Our models are only as good as the questions we ask and the data we feed them. In 2026, it's not indecision to adjust course, it's smart, especially when the map itself is changing under our feet.
Here's hoping central bankers keep their telescopes trained on the stars. And remember, even if those stars move, it's their job to keep guiding us safely by them. The next decade will show if our institutions are up to that challenge.